Dear students, now in this video, we will learn how to prepare the cash flow statement. Just please understand one very important term that I had frequently used, that is cash and cash equivalent. See the meaning of cash and cash equivalents technically, which is applicable with reference to this lesson. Cash and cash equivalents are short-term, highly liquid investments that are easily convertible into cash and which are subject to an insignificant risk of change in value. All the assets which are of short-term nature and generally they are highly liquid nature, which means that they can very easily convertible into cash and they does not have the significant effect or risk relating to the changes in their value. They are categorized as the cash and cash equivalents. In other words, cash equivalents are held for the purpose of meeting short-term cash commitments rather than for cash investment or any other purpose. An investment held for short-term maturity, say generally for 3 months, can be regarded as the cash and cash equivalents. Some examples of cash equivalents are treasury bills, commercial papers, etc. On the other hand, cash flows are inflows and outflows of the cash and cash equivalents, as we had already discussed. A cash inflow results in increase in the total cash balance and a cash outflow results in the decrease in the total cash balance. So this we will apply with reference to the preparation of cash and cash equivalents with reference to cash flow statement. Now, how the cash flow statement is prepared? So here, first of all, we have to understand the format and the method. There are two broad methods through which the cash flow statement can be prepared. One is known as the direct method and other is known as the indirect method. Generally, the indirect method is applied because direct method is difficult, and in examination, if nothing is mentioned, we have to solve the problem through indirect method, and generally indirect method is easy and we can very easily apply this method. Now under indirect method, again as I share with you that we have to calculate and understand three types of the activities, that is operating activities, investing activities and financing activities. Now we will calculate step by step cash inflows or outflows from operating activities. Inflow here means that when the cash is coming, and outflow when there is outflowing of the cash. So first heading is cash flow from the operating activity. As I share with you that operating activity means principal revenue generating activity, which means that from where the revenue is generated to the main business activities, they are called as the principal operating activities. Now what are the important heads from where the cash can be collected, inflow or outflow through the operating activities? We start with the net profit before tax and extraordinary items. We will discuss one by one all those items. Basically, cash from operating activities is divided into two parts. First, it is relating to the non-cash expenses and non-operating expenses, and second part is associated with the changes in the working capital, that is the changes in the current assets and current liabilities over a period of time. So cash from operating activities is calculated in two parts. First, we will take the effect of non-cash expenses and non-operating expenses, and second part we will take the effect of the working capital changes, that is changes in the cash inflow and changes in the cash outflow. So let's understand for the first part. We will start from the net profit before tax and extraordinary items. Now here tax means income tax and net profit before tax means before deducting the amount of tax we have to take that net profit amount. In case there is net loss, again the working will be same but the amount will be in the minus sign and calculation will be done accordingly with taking net loss as the base. See here what non-cash expenses and non-operating expenses we had added, that is the depreciation, goodwill, interest paid, loss on sale of fixed asset, foreign exchange changes, See, these are all generally non-cash and non-operating expenses. And here we have to take the difference, or we have to take the value of change from the ending of the previous year and to the end of the current year, or over a period of time or dates which is given to us. Non-cash, non-expenses, non-operating expenses we have to add back. Likewise, we have to deduct from this non-operating incomes, that is like the dividend received, profit on sale of fixed asset, rental income, and interest received. These are generally non-operating incomes. When we deduct all these items from this, the result will be, if in the plus, operating profit before working capital changes, or if there is loss, we will say operating loss before working capital changes. Then we will take the effect of the working capital changes. Here means that changes in the value of current assets and current liabilities over a period of time. Now please understand, when we have to take the effect of the working capital changes, we have not to take the effect of the cash and cash equivalent items. As you all know, the cash and cash equivalent items, they are generally basically the part of the current assets and current liabilities. So we have not to include the effect here, because their effect will be taken in the cash and cash equivalents. So here, except the items of cash and cash equivalents, we will take the effect of remaining current assets and the remaining current liabilities. Now, what the rule is there for taking the effect? Rule is there that if there is decrease in the current assets or increase in the current liabilities, it will be added here. And if there is increase in current assets and decrease in the current liabilities, it will be subtracted from here. Just understand, the simple rule is there that if there is increase in the value of any liability, that will be added. If there is decrease in the any value of current asset, that will be added here. Likewise, if there is increase in the value of current assets and decrease in the value of current liabilities, it will be subtracted. The basic objective is here to understand that with reference to the current assets, reverse rule is followed, that increase will be deducted, decrease will be added, while with reference to the current liabilities, direct or positive rule will be followed. Increase in current liabilities will be added, decrease in current liabilities will be deducted. So this way we will undertake the effect of current assets and current liabilities. Then if the result is there, again after adjusting second part also, plus we say cash generated from operating activities, or if the result is in minus, we will say the cash lost in operating activities or cash used in the operating activities. So this way we will calculate first very important head, that is cash flow from operating activities. Sometimes generally in the examination, question asks only for the operating activities, so we will understand this in this way. So know how to calculate cash from the operating activities. I will continue in my next video relating to the calculation of cash from second very important activity, that is investing activities, and also cash from the financing activities. Sometimes some additional information is also given, we will share accordingly, and I will also share with you the treatment of the income tax or provision for income tax, proposed dividend, or for the provision for dividend in our next video.